Welcome to Dividend Talk, episode 182. An interview with Chuck Carnevale, also known as Mr. Valuation.
Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom and I'm joined with my co-host European DGI. If you want to learn more about us, please visit europeandgi.com where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. European DJI, how are you, my friend?
I'm actually doing really well, although I had a very heavy week at work. I know you as well, right? I'm really excited for today, of course, because we've got Mr. Valuation today as a guest on the podcast. And I'm looking at you, Derek, at the moment, and I see there a little book, which is Charlie Munger's Almanac. And I remember there was a lot of wisdom in there when I sent it to you, and because I've almost read it till the end. And I have a feeling that today, and I know it's, I don't want to even try to make the comparison, Chuck, but I do know that many people follow you on the social media channels, are signed up to FastGraphs as well, because they see you also as a book of knowledge. So really, really happy to have you on here.
But, don't compare me to Charlie. I mean, rest his soul, he was brilliant. In fact, one of the people that taught me, by proxy, everything I know, actually.
Yeah, I mean, it's hard to compare against Charlie, but honestly, thank you so much for coming on. I cannot wait for this. We've got a lot of people writing in to say how happy you are that you're on the show. We even had somebody say that they love you. So there's a lot of love out there. So I'm looking forward to getting into your story and into some of your philosophies and actually talk about some European companies as well if we have some time.
Yep.
But before that, we usually ask our guests to just say a couple of words about who they are. I assume most people would know, but maybe just introduce yourself just a little bit.
Yeah, well, of course, I'm Chuck Carnevale, of course, and I'm born and raised out just a little town outside of Pittsburgh, Pennsylvania. Army veteran, Vietnam. One of the questions I saw that one of your people asked about. So I spent 1969 in Vietnam. I was a infantry officer, psychological operations. That was quite an experience. It's part of the story actually because I had 2 years of college behind me, and I got drafted, so to speak, and the military had a program where you paid $1 and they sent your transcripts to 100 schools. And the first school I got was University of Tampa in Tampa, Florida. And, being a boy from the cold north, Florida sounded really attractive. So I got down there, and actually my original mentor and the one that got me involved in the investment business was my economics professor. He was also a dean of men, and he was, I'll tell more about that later when it's appropriate. But that's how I kind of got started in the investment business.
Yeah, I mean, I can't wait to get into some more of them stories, but we'll stick to our natural flow of the podcast. And at this moment, we usually talk a little bit about the news of the week. And I think the big one this week, there's no denying it, is Meta, Facebook. They are now a dividend-paying company. I mean, what are your thoughts on that, guys?
Well, it's Meta's following the same pattern that great companies in the past like Amgen, Microsoft, have followed. When I'm going to predict Amazon at some point. you know, when companies are young and small and they're growing very, very fast at, you know, 25, 30, 40% rates like Meta has for so many years, they need every bit of capital they can get to basically fund the growth. And even Amazon, you know, Jeff Bezos talked about that, how he was going to generate a lot of cash, but no profits. And he was prophetic in that. But what happens is once they get so big and as big as Meta is, you know, they have trouble finding places to really invest capital where they can get the proper returns on it. So the most common sense thing for them to do is to share their existing profits with their shareholders. And they start to pay dividends, and then they kind of merge from a growth stock into a dividend growth stock, and ultimately, you know, just an income stock in the future. But I think Meta will probably be a good dividend growth stock for a long time to come, depending on, you know, what their philosophy about investing, about paying dividends to their shareholders are. That's still yet to be determined. It's intriguing.
Yeah, I noticed that as well. I went through the message. At least they will start indeed with 4 quarterly dividends, so $2 per share in total. And I'm very curious about this one because, Derek, I don't know if you remember, but we were predicting that either Google or Meta would be within 2-3 years paying a dividend because all the signs of the maturity were there. But I believe that at a certain moment, Mark Zuckerberg really started to invest heavily in the AR. And I think then some shareholders started to object. And now we see that suddenly there's a lot of let's say, respect for the shareholders in the form of distributions, buybacks. And I think they went a little bit too far at the time and too early with virtual reality here. And it feels like there's no more sense in their capital allocation policy. But it's very interesting because what I find the timing so interesting. I mean, I don't know if you've seen this week the hearings in the US about what was it, child violence and everything, online topics. He had to apologize in front of the families of the victims behind him, and literally 4 days later, or 2 days later, they are announcing a dividend. And you know, I find it really awkward because he's being positioned there as the bad man who is earning money over the back of the vulnerable. And then 2 days later, he gives himself a $200 million dividend check on an annual basis. Yeah, so
I'm sorry to interrupt, but he also, in his opening testimony, denied the fact that, you know, his social media platform was harming children, and then later he had to apologize. So it was kind of a interesting dynamic there.
Yeah, and so it makes me still a little bit feeling uncomfortable because I own a few shares in Meta. Many people see it as a sin stock, like a tobacco stock in our community. There are many people against it, and we know some of them, like Alan, they simply don't want to ever touch something which owns Facebook, as an example here. So I find it a very intriguing story. Also, for instance, the big risk of regulation, right, on these companies. We see already what's happening in Europe and what it can do to its advertising model. And from that point of view, it is quite singular in what it's doing. If the ads fall away, this company can really get into, you know, under pressure. Let's call it like that here. So it will be very interesting to see. But it feels, from a dividend growth point of view, what you mentioned, Chuck, it resonates a little bit. How you say it? It feels a little bit like Starbucks not too long ago. I vividly remember Starbucks doing the first one. You could kind of feel it that it was in the air, but then seeing it happen was really the moment that you knew, like, okay, now this is going into another phase.
Amazon will be next on the list. But I tell you who is happy is my son. He's 13. He has his own portfolio, and remember at the start of the year he had a goal to increase his dividend income. Obviously, he's probably listening or trying to look up to me in some respect. But he was so happy that Meta are now paying a dividend because they are in his portfolio. He picks all his own companies, Chuck. I don't pick anything. So he was like all excited. This is an extra, I don't know what he's getting from that, but he's getting extra money that wasn't there before. So it's getting closer to his goal. So he was. He
had a nice 20% pop today.
Yeah, exactly. Yeah, his portfolio is beating mine. I mean, I need to start listening to him.
Well, you know, I probably should. You know, I started out as a growth stock manager, by the way, but that's part of the story we'll talk about later, maybe if we get time.
Nice.
So, do you know what? I think we'll just jump straight into the questions, Chuck. And look, I think we should go right back to the beginning, if you don't mind. Take us back to where it all started for you. Do you remember it, and what was your inspiration back then?
Well, you know, first of all, even as a high school student, I was like your son. I really commendate you on that. That's great that he's, you know, involved in that already at that early age. But I was always interested, but I didn't really understand it. So when I went to University of Tampa, my economics professor did something every day in class. So he would teach it, and we were talking about stocks, and he would take his hand and he would literally pound his desk, and he would say, "Earnings determine market price." In fact, interestingly enough, the name of the money management firm I started was EDMP, Earnings Determine Market Price. And he had a study that Pershing had conducted back then, a research study, and it was spanning about 5 decades. And it showed the correlation between the S&P 500's earnings and their market price over time. And it just really struck me. It ended up becoming my life's work. But the problem was I couldn't find anything that was showing this relationship between earnings and market price. So I ended up building my own. It's now called FastGraphs. My wife and I used to take an hour and a half to build one stock chart. Now we've got 80,000 in the FastGraph tool. So, you know, it was a good evolution. But that's how I kind of got started in the business. And it was very intriguing to me. And like I said, we started out as a growth investor. And, you know, I was looking for those 10 baggers like Peter Lynch talks about all the time, you know, originally, and finding them, by the way. And it was, in fact, looking for companies with very high earnings growth. And FastGraph started out using Peter Lynch's formula as a foundational formula, the P equals growth rate, now referred to as a PEG ratio by a lot of people, but that's a bit of a misnomer. And, you know, it just became my life's work and ended up being what I've done for 50 years. And once I basically figured out that it was earnings or fundamentals that really matter a great deal, that's something that I think people in investing, everyone's so price focused. But as Warren Buffett said, you know, price is what you pay, value is what you get. And then it was interesting, you mentioned Charlie Munger earlier. You know, it was, you know, Buffett got his, you know, cut his teeth with Ben Graham, of course. And Ben Graham was the cigarette butt, you know, original value investor guy. And Charlie Munger actually brought the idea that earnings growth, you know, bought at a reasonable price was actually the secret to long-term success. And, you know, so although they're still value investors, they also recognize that, you know, return comes from the income stream that a company produces, you know, whether it's, you measure it by earnings or cash flows or sales for that matter, the top line even matters, but that's ultimately what gives a business value. And we'll talk about that some more.
And what I'm really intrigued with is that you said you started as a growth investor looking for those 10 baggers and then switched to value. And I'm curious to how that process went and why I'm asking. A few weeks ago, I was pondering a lot with this thought, like that we often get the question, like, why don't you buy growth? And then once you're at this level of that you could be financially independent, switch your portfolio to dividend stocks and dividend growth stocks. But in my mind, those wires don't work, because it suggests to me somehow that with growth investing, and I'm still looking for the definition here, yeah, would outperform any other investment style like dividend growth investment. So it's smarter to go for growth and for your way to outperform and then switch it to a lower performing strategy. I'm very curious.
That's a theory, and there is some credence to that theory, but let's put that into perspective. First of all, what we're not bringing into that equation is a discussion of risk. Mm-hmm. And the problem with growth is that it's very, very risky. First of all, it's very, very challenging. Like, I'm looking at a FastGraph on Meta, and since its inception, its earnings, adjusted operating earnings growth, not diluted or not, you know, GAAP earnings, but its adjusted operating earnings growth rate has averaged over 30%. Well, that's an extremely difficult thing to achieve, and there's a great deal of risk involved in that. And when their earnings actually fell 38% in 2022, for example, you know, the stock actually took I'm going to do it roughly here, it took a 7 to 4% dive. And people don't realize that, because the multiple, you know, they were trading at a 28 multiple and they ended up going down to a 10 multiple. because their earnings fell, but then of course they recovered immediately. And since that time, the stock has, recovered all of that back and gone on to new highs like we are now. So the problem with growth investing is you're dealing with a great deal of difficulty in accomplishing at least 15 to 20% growth is how I would define a growth stock, by the way. We actually do that on FastGraphs. And it has to do with the rule of 72 and the power of compounding, which, maybe more than we want to get into today. But the point is, that's what real growth is. And to me, it's not growth of the stock price. And you don't define growth by stocks that have high PE ratios. You define growth by how fast the company grows their business, how fast their sales grow, how fast their earnings grow, how fast their cash flow grows. And by the way, all that's joined at the hip. There's a relationship to all those things. So the problem with being a growth stock investor is if that growth, it's like a friend of mine used to refer to it as playing musical chairs with your money. It's great when you're dancing around the chairs as when the music's playing, but if the music ever stops, you better have a chair to fall on. And of course, the chair is going to be fundamentals. So risk is a very relative thing. And now when I started out as a growth investor, I was 22 years old and I was fully, and, I was invincible and bulletproof. And, I was willing to take risks because I had my whole life ahead of me. But, now that I'm in my 70s, I don't look at risk the same way. And so, it comes down to what I say controlling risk, because investing, and this is one of my pet peeves, by the way, guys. Investing is not always about trying to make the most money. I would agree that growth stocks have the potential to do that for you as long as you're right, as long as you pick the right ones, as long as you buy them at the right value, not price, but value. And, as long as you're willing to stay the course, because Starbucks, you mentioned earlier, was one that went through a little problem. I forget what year it was now, but their stock dropped over 75% at one point. Yeah. Yet it's recovered and gone on to all-time new highs. But how many people are willing to ride a stock down 75%? Put 100 grand in the stock and see it go to 25 grand. That's human nature. The investor psychologists tell us that investors feel the pain of loss 2.5 times greater than the pleasure of gain. So, the other side of that is that I think is something that's really important to me is when, people buy bonds for the certainty of bonds. They don't buy bonds because they think they're going to make more money than investing in, for example. They buy bonds because they feel that they're safe and they control risk and that they provide income. So, depending on what your investment objectives are, what your situation in life is, how much risk tolerance you have, your psychology is critical to this discussion. How it makes the decision. Here's why I have evolved into dividend growth investing and why I love it as much as I do. Number one is, if you look at a FastGraph tool, there are basically 3 lines on the graph. There's the earnings line, and that's usually pretty, for good companies, that are, what I would call blue chip type companies. Earnings tend to be very consistent. They tend to grow at different rates, from, a low 2 or 3% on a utility stock to, 30% on a stock like Meta, or average about 8 or 9% like a Home Depot or Johnson & Johnson, something like that. These are US companies I'm talking about. But the problem is that there is cyclicality. Sometimes those earnings drop. If you look at the price line, like say we put weekly closing stock prices, that's complete, psychosis. I mean, the stock price line is nervous, unpredictable. You have no idea where it's going to go tomorrow. People want to think they do, but they don't, including yours truly. But then the most certain line, and the only thing certain about the future is uncertainty, number one. So investing is all about dealing with those levels of uncertainty. With dividends, the most certain and most predictable, calmest, if you want to call it that, usually constantly ascending line on a stock graph would be that dividend line. These companies that are dividend champions and aristocrats and even challengers, these companies that increase their dividend 10, 20, 30, 40, 50 years in a row, and they've raised it every year. These are the companies that give you a level of certainty that is otherwise unattainable in the investing world. And that's why I love dividends so much. And they do give you the opportunity to hedge inflation. And you talked about, we were talking earlier about, having money for retirement and reaching a certain level of income or wealth and so on. and where you have enough income, you can generate an income. Well, dividend stocks can do that, but they also give you a raise in pay each year if you pick the right ones. And, you know, if you have say a 30 stock portfolio, which I kind of profess, you know, it's very unusual to see one or two of those stocks cut their dividend. They do. There is no real certainty in investing, but probably the closest you're going to get in the equity side, at least, would be with dividend paying stocks, especially consistent payers.
Yeah, and I think we have also learned over the last few years with the inflation that we saw that our salaries are not keeping up with inflation, but our portfolio is doing a pretty good job there. Yeah, and for me, maybe still one more question on this topic is like, do you kind of agree with the narrative that growth investing is the way to, let's say, outperform a dividend growth investing strategy? Because we often feel like, based on the narrative of the question, is that you should get quicker to the financial independence or the portfolio threshold that you need to call yourself financially independent, and then switch over to get the dividends.
Well, the potential is there. Okay, but as I said earlier, the challenge is the difficulty in a company achieving. Here's what happens in the real world. If you're a company, I mean, look at Home Depot, they got Lowe's. You know, look at Walmart, they got Target. You know, you know, I think you guys have a competitor to Amazon right now, don't you? Somewhere around Europe. And of course, you know, the point is when a company goes out and they can make, you know, these 25, 30, 40% growth rates year after year after year, well, they invite just enormous competition. The market will not let you do that forever. And so it becomes more and more difficult. Not only is it more and more difficult to find those kind of investments, you know, that you can reinvest your money in, that can give you the returns on equity and return on investment to continue to achieve those kind of growth rates, then you also start facing an enormous amount of competition. And then there's the law of large numbers. The bigger you get, you look at Meta, it's now a $1 trillion market cap plus. Well, it's pretty hard to go from 1 trillion to 2 trillion. I used to like to tell the story about Ray Kroc when he bought McDonald's. He bought 4 stores. I think they got something like 60,000 or 40,000. I don't even know the number. But my point is, you know, you can take 4 stores and grow to 8, and you can grow by 100%. But try to take 40,000 stores and grow by 100%. So the law of large numbers really comes into effect there. And so the idea that growth stock investing from a theoretical point of view will outperform is true, but it's very, very difficult to achieve that growth. You've got a lot more predictability with dividend growth stocks. So, you know, I did, you know, morph a lot of clients over the years from pure growth stock investing, which we started out, as I mentioned earlier. And then as we got bigger, we started moving into growth stocks. But we also had many of our growth stocks like Amgen, Microsoft, you know, Starbucks. They all of a sudden, Home Depot, Lowe's, they all of a sudden became.
Exactly.
They did it on their own. I didn't have to switch my clients from growth to the income. The companies did it for me. They became dividend paying stocks, you know, for the reasons I mentioned earlier in this podcast.
I guess it comes back to then risk and volatility. And if you put it on normal distribution, there's more, I guess there's more likelihood, or there's a possibility that you can get this outperformance, but it comes down to stock picking the right ones. And that's where you have also a higher risk of failure. I guess that's what it's probably is.
Way higher. Yeah, way higher. That's the point.
Yeah. I'm curious about your portfolio, and I know you profess this 30 companies within your portfolio. What would it take for you to add a new company into that, or even sell an existing position within your portfolio?
Well, number one is, you know, like Buffett has always said, you know, the best holding period is forever. So the idea as a value investor is to first of all identify companies that you think are great, that have long-term potential, and that you can buy at a reasonable valuation, which is, you know, the number one thing for me is always it's got to be at fair value. It's one thing to find a great business and then have it trading at 2 or 3 times its intrinsic value. The business does great and you do lousy. So if valuation gets extremely high, I would maybe be forced out of a company. But my goal is to buy the business and invest in the business, to be a long-term shareholder and let the business make me the money, not the volatile stock price. Stock price is going to go up and down thousands of times between the time I buy it and the time I sell it. So as long as the fundamentals stay intact, to kind of answer the question there, then I'm happy to hold. And if the price drops, for example, and I still see good fundamentals, my first inclination is not to panic and sell. My first inclination is, can I find some way to add more? I might trim a position, or and by the way, the beauty of a dividend growth portfolio is I'm constantly getting fresh capital coming into the portfolio anyway. So I can constantly be putting that to work and allocating it to where I see value within the portfolio. In other words, I'll buy the stock that, like, one of my larger holdings is Broadcom, and it's gotten now to the point where it's getting extended in value. I wouldn't buy it today, but I've owned it for 7, 8, 9, 10 years. I'm not even sure. And now that's my worst nightmare as a value investor, when my great businesses become expensive, because now I've got to make a decision. I talk about this often, but my mantra is, and this is something I borrowed, I didn't invent this statement, but a portfolio is like a bar of soap. The more you handle it, the smaller it gets. And the idea of that is, you end up with things like taxes, you end up with things like costs, you end up with things like making mistakes. You have to not only make the decision to sell something, now you have to make a decision to buy something else. And by the way, the one thing about value investing that people really don't get, you have to exercise a great deal of patience to be a value investor, because almost by definition, great stocks that you can buy at good values usually have some problem associated with them. I mentioned Meta a while ago, back in 2022, when their earnings fell 38%. Well, that's why the stock price fell. But that, and it was Marty Whitman, the Third Avenue Value Fund manager, that said it really well. And I'll paraphrase, but I'm pretty close to quoting him. He said, you have to make a distinction between a temporary interruption in a great business and a permanent capital. Well, the point is, if you're finding true value, especially in the U.S. market, when you're looking at this bull market we've been in since coming out of 08 and 09, you got to be real careful not being a genius in a bull market, because when stocks are running like that, everything looks good, and people throw value out the window. But to find value in that kind of market, there has to be an issue. There has to be a Monsanto, dealing with something like they're dealing with, or Bayer. Bayer's had struggling earnings now for several years. And, the idea here is identify that great business that's having a temporary interruption in their, long-term performance, but that they're going to recover and be a great investment over the long run, and you can now buy it on sale.
Yeah, I think Derek and I have experienced over the last several years that there's a thin line between a value play and a turnaround play.
Yes.
And those turnaround plays, I'm doing less and less. For instance, Intel has been my last turnaround play, but I try to avoid them more and more, because I've noticed that that there's often a broken story to it. And in this case, we know that Intel needs to reinvent itself in a highly competitive landscape, which makes it not anymore really a dividend growth investment. They cut the dividend as well. How much can you count on this? So it's also really like, what is your strategy, right? So in my own portfolio, I have, let's say, 5% nowadays dedicated to a little bit playing around. I call those value plays that are not necessarily dividend growth investments. So I had Meta in there as an example, because at $170, I thought, like, come on, guys, with so much cash coming in, I would be crazy not to have it. But I try to really limit the size in my portfolio so that I don't get distracted from what I'm really trying to achieve, and that's growing dividends, growing dividend income with high quality businesses.
Yep. And mature businesses typically, by the way.
Yes.
Which gives them a little bit more certainty.
Yeah, true. But sometimes it's really obvious. I remember, to your point with AbbVie and the Humira patent cliff at the time. From what I studied in pharma companies, I knew that biosimilars are so difficult to produce and to get approval for. So I felt like the market was way too overreacting compared to their predictions. Like, that would literally be a cliff. But if you see how this goes all with patents, and how they extend and how they make deals with other companies, this is actually quite normal. But you need to understand a little bit then how pharma deals with these kinds of things, specifically in this world. And that was, for me, a really nice example of a value play that really played out well as well.
The one that I point to a lot is Cardinal Health in the U.S. here. They went flat. You know, people forget Microsoft was filling at single-digit PE ratios 7-8 years ago. You know,
that's when I bought. That's when I bought, and Apple as well.
That was when I was blogging on it or doing videos on it, and people tell me I was a moron. I love people anyway.
So maybe let's talk about FastGraphs then, just a small bit. What you mentioned Peter Lynch there earlier, but what was your inspiration around starting FastGraphs?
Well, again, it was my professor showed me that Pershing study, and it showed the relation between earnings and market price. And FastGraphs is an acronym. It's Fundamentals Analyzer Software Tool. And one of the things that I really have kind of dedicated my life to is trying to convince investors that they need to focus more on the business behind the stock and less on the price. The price lies. I did an article in Seeking Alpha many years ago now that I titled it "Stock Prices Are Pathological Liars." And, you know, Buffett once said that, you know, he'd be a bum on the street with a tin cup if the markets were always efficient, you know, begging for nickels or whatever. And the reality of it is you have to, first of all, come to the conclusion or come to the realization, not conclusion, that stock prices don't always reflect the true value of the business you're investing in. Sometimes they overvalue it and sometimes they undervalue it. And by the way, you know, even though value investing always comes with some type of a problem, there are cases where, you know, like for example, Johnson & Johnson went through the 2008-2009 U.S. financial recession with earnings growth and dividend growth. You know, the only thing that fell was their price, not their business. Their business actually performed extremely well. And I think that's the key, to be able to focus more. And that does require patience. A good friend of mine said, you know, companies only report quarterly or 4 times a year, whichever comes first. And he said that obviously as a joke. But the point is, you only really get what I would call meaningful news on a company when you finally get their quarterly financial statements produced. You know, everything in between that is noise, hype, hysteria. You know, there's something that's meaningful, you know, piece of information that'll come about a company, but the real information is going to come when you actually can review their fundamentals. You can look at their 10Ks, you can look at their, you know, annual reports, you can look at their balance sheets and their cash flow statements. That's when you can get real information on a business. And if you focus on that, and then, you know, the idea of FastGraphs reveals that. I always like to say it's a tool to think with, and we don't dictate valuation. We try to give the investor the ability to see where valuation is. And so that if they're investing, even if they want to take that gamble and say, I don't mind overpaying for this stock, because there are stocks that you can, you know, overpay for and still make a great deal of money over the next 4 or 5 years. But you should do it with your eyes wide open. You should recognize that you're taking a valuation risk. You know, and by the way, PE ratios are, you know, one measurement of value, but the real value is the inverse of the PE, and that's the earnings yield. And earnings yield relates very, very nicely to dividend yield. You know, dividends are a payout ratio of earnings. That's what a company does. So, you know, the point is you want to have a company who, you know, what earnings yield really means is if you own 100% of the company and they paid 100% of their profits to you in dividends, what will your yield be? And my minimum threshold is 6.67%, which happens to be a 15 PE ratio, which Ben Graham said, you know, in his book, you know, never pay more than 15 times earnings. And it's a barometer. It's not necessarily the end all number. It's just something for you to say, if I'm not earning at least 6.5 or 7%, on all the company's profitability, which they don't pay me anyway, they just pay me a dividend, a payout ratio, you know, why would I want to, you know, take the risk of accepting a lower return? And the only way to do that intelligently is in a growth stock, because then you're dealing with future earnings yields, not current earnings yields, on the basis that you're going to get, you know, that 30%, 20%, 25% growth rate that's going to compound those earnings at a high enough rate for you to make money in the long run. Otherwise, you're taking risks you shouldn't take.
Yeah. And you know, Chuck, I've been following you probably now for 9 or 10 years on the different platforms, and I also use FastGraphs for quite some time, because I said it was so helpful to do a lot of the analysis already for me. Now I'm more myself only in 10Ks and such, because I know what to look for a little bit easier. But I called it already more advanced. But you're in your 70s. You're spending all this time online to help others and such. What is driving you? Where do you get the passion from, Chuck?
I tell my children, by the way, and would recommend this to anybody. You need to find what you love and then do what you love. And so I love, like, for example, people ask me, when am I going to retire? Well, I loved Warren Buffett's answer to that question. He said 5 years after his demise, he was gonna cash it in. and the thing about it is, everything I do, I'm doing almost as a hobby, I guess we'd say. It's what I'm passionate about. I wouldn't really call it a hobby as much as, if I get up, I'm looking at the stock market. I'm on the computer looking at the market. I'm trying to analyze companies. To me, it's the greatest puzzle game there is, to try to take a company apart and figure out, if it makes any sense or not, if it's a good business, if it's got, sustainability and blah, blah, blah. And so I love what I do and I do what I love. And, I don't work as hard as I did. I have a young son who's doing most of the heavy lifting with FastGraphs now, as far as developing the tool and adding the new features and so on. I have a great deal of input, but, I couldn't imagine doing, sitting around. I like to play golf. I couldn't imagine playing golf more than about once or twice a week. I got to have something to keep me alive and keep my mind going. And the idea that, you can help people is just a bonus. It's really icing on the cake to me.
So, I'm not surprised that one of our listeners, Miłosz, mentioned that he loves you, because I think it's very visible, the passion you put in the community. So also thank you from my side for that, because I think you have impacted already many people, Chuck.
It's gratifying to hear that. I will say that.
And then based on this passion and the fact that you give so much time to help and inspire others, what do you wish that retail investors would understand better?
Well, to me, it's the essence of FastGraphs. I wish they would understand the businesses behind the stock better, so that they don't let stock price cause them to, make bad mistakes. EDMP was I have a money management firm, and I named it Earnings Determine Market Price, dash in the long run. There's an evil twin sister, EDMP, that says emotions determine market price in the short run. And the idea there, that's what I mentioned before, where the investor psychology says, people feel the pain of loss 2.5 times more than they do the pleasure of gain. The point is, pardon me, don't let your emotions rule. The two dominant emotions are fear and greed. And fear, by the way, is the most powerful. I can tell you that, living through several, what I'll call major bear markets, 1999 to 2000, 2008. And, people panic, and they panic because they become price focused. And, if the price goes down, they're panicked. Why is it going down? The world knows something I don't know. Well, look at the fundamentals. If the fundamentals are solid and good, then you should be able to invest in that company at that time aggressively. You should be able to do it with confidence and because now what you've done is you've taken less risk to do that. So I don't know. I think I went off on a tangent, Derek. I'm not sure which asked me now. What was the question?
But what you're saying resonates, I think, a lot with us, because our listeners typically, we asked a question the other day, like, what have you really learned from us? And it popped up a lot. We often say you can't borrow conviction.
Yes.
And that's something that we really always try to share. Like, guys, at least read one time the report, or go to the website, understand the products, try out the products, get a feeling for the company, right? Because once the stock market crashes, you're there seeing a price chart going down 30-40%. And you need to have conviction in this business. And many people, they buy stocks because they hear it on social media from others, and just buy. And that's really where I wish, to your point, people spend more time in understanding the business indeed.
I used to do a lot of public speaking and seminars and things for people, and I used to always tell the story. Back in the day, it was Kmart, and Kmart had the blue light special. And I said, imagine you're at the Kmart, and you could put Walmart or Target or any retailer in there. And you say, imagine you're you walk into the store, and the store's just absolutely mobbed with people. Every aisle is full, and people have shopping baskets, and the baskets are piled to the brim. And then all of a sudden the manager gets on the loudspeaker and he says, to thank all of you for being such loyal shoppers to our store, we're going to put everything on sale now for the next hour at 50% off. And everybody abandons their cart and runs out of the parking lot and leave. And, you know, the stock market's the only market in the world where when things go on sale, people abandon it. They run out of the market. It really doesn't make any sense, you know. But again, there are times when it does make sense. There are times when the business, look at a stock like Pitney Bowes, for example. You know, they used to sell stamps, you know, and stamp machines for businesses. And of course, you know, their business became obsolete and their earnings continued to deteriorate. And it fell. So if the fundamentals are deteriorating to an extended rate like that, then, you know, that's not the time to be patient and stay in the stock. You got to be able to make that distinction between a temporary interruption, as Marty Whip said, and a permanent impairment of capital. Because
and the good thing is with dividend stocks and blue chip companies, we usually get a lot of warning signs upfront about that something is going on, because usually, I like this concept of slow compounders. If you really compound slowly, that's usually a sign of a market with high entry barriers, as an example, where it's not easy to compete. So you need to invest a lot, but also that means for others it's harder to take market share. So you often see flattening earnings, slowly declining earnings, and that's what has helped me out, because for me, Chuck, selling is one of the most hardest. When to sell, and I try to avoid selling, but it continues to be one of the hardest. Yeah.
But you bring up some other thought for me too that I think people ought to talk about. You take a cyclical stock like Cummins, the diesel manufacturer in America, and there's a couple on some of the international stocks I looked at that you guys were talking about. You know, dividends tend to continue to grow even for these cyclical stocks. Again, that's the one most where you see the most certainty in evaluating that dividend keeps increasing as long as the cash flows and the free cash flows are supporting the ability to pay dividend. And then for some companies, even the retained cash flows and earnings, you know, with these companies, even though they know they're going to have cycles, but they, you know, maintain that long-term dividend record.
Yeah. I'm glad you brought up that we sent you some European companies, so I'm quite curious. Did you get a chance to run them through FastGraphs? And if you did, what did they look like?
And by the way, first of all, they all look like excellent companies. So I do want to say that. I'm afraid to pronounce some of the names because I don't, you know, my language is English, and some of these have some German sounds to them. But of the 22 names you guys sent me, I did come up with 5 that I thought met the value criteria, and you know, they were all pretty much, the stocks you sent were all pretty. You know, I like the pattern of the stocks. I like the fact that they were you know, consistent earnings growers, consistent dividend payers, but the problem was many of them were way overvalued. There were only 5 on the list. I mean, 6 on the list that had earnings yields above 6.5%. And that was in alphabetical order. I'll put them in alphabetical order here. That was Ahold, which I think you guys just recently did a video on, wasn't it?
Yeah.
That one looks really excellent with a PE of around 10 and a very, you know, nice earnings yield of over 9. And Allianz was another one that was a little more cyclical than I like, but it looked really good. Ambra, which is the winery, this one's selling a little bit above its historical valuation, but it still looks very attractive at only a 12 PE. And then, of course, British American Tobacco, which, you know, some people can't find it in them to buy, you know, SIN stocks, but it's certainly extremely cheap with a very high dividend yield, obviously. And then Freshness is, how do you pronounce that, guys? The healthcare company.
Fresenius.
Fresenius, yeah.
Fresenius. Yeah.
And then Kering, the luxury goods manufacturer. Those 5 were excellent in terms of valuation, as well as you know, the kind of consistent earnings growth I want, generally speaking. The real problem with some of the other stocks was they were fabulous companies, but I just didn't like the valuations that I saw. You know, in other words, I would be very remiss in doing this podcast if I didn't talk about this. And I think what people really need to understand about the essence of value investing is what a true value investing decision does. It allows you to fully participate in the business you're investing in. If you overpay, the business can do great and you can do poor. If you underpay, you can actually do better than the business generates. But the point is, that's what real value investing is about. It doesn't mean always that you're going to make money either, because you can buy value traps when they're at value, but obviously the business, you participate in the downdraft of the business. But to me, that's the essence of value investing that's often overlooked. And I like to talk about that because, if I identify a great business and I want to own that business because I love the business, I don't want to, overpay for that business and then end up not making any money.
Yeah, and I would say you brought up a few nice names, because I would say Koninklijke Ahold Delhaize is the one that I'm really a big fan of. I'm also biased there. I don't know how well you know the business, Chuck, because you might actually go there.
I went to the website and looked around at some of the U.S. Stores that they own.
Yeah, exactly. So, and how are those stores? So quickly collecting some
I
customer
don't know
feedback.
all of them, because some of them are in different markets than I'm in.
Yeah.
But, they're all reputable stores, and but that's a nice steady eddy. They did have a little issue here recently, and earnings wise. But I also want to make this other point about value investing, is that their earnings flattened a little bit, and it did cause, I'm going to say if you just kind of midpoint performance for capital appreciation over the last 4 or 5 years, it hasn't done a lot, but it did pay a special dividend, I think in, was it 2019 or 20, or an extra dividend, and it's had really great dividend growth. And I'm misspeaking because I'm not using my FastGraph tool. They actually didn't do that, because they did have a special dividend, it looks to me like in 2019 maybe.
A little bit earlier, maybe, when they bought Delhaize, because they kind of merged with the Belgium company.
And that might be what I'm seeing there. I'm looking at it in euros. That's one thing you can do with FastGraphs. You can, it's a currency that you want to, look at the stock with, and it's real important to look at these stocks, the European stocks especially, with or international stocks is what I really want to say, through their currency of origin, because otherwise you get into exchange rates and. You get some what I call muddy water as far as what's happening. You'll see companies that have looked like they have dividend cuts when they didn't. It was the exchange rate, that caused it. But I like all those companies because they're all trading at good value. They all have, by the way, very nice dividend yields, the 3 and 4% range, and they have real great growth. Like Klondike, I'm showing Ahold has average growth rate of over 15%, dividend growth rate of over 15%. Which is very, very nice, because we talked about that earlier. This idea you get a raise in pay every year. What a better way to fight inflation than to do that. And a company that's solid and steady like that is maybe sometimes a heck of a lot better in your portfolio than that growth stock we talked about earlier. That where their valuation, like a Tesla, who moves 50-60% every year up or down. You never know which direction it's going to go in, and it's pretty hard to stomach those. But there's some really, really nice companies on that list, by the way. I don't know enough about, we just launched our international version just early last year, and we now have 80,000 stocks on FastGraphs, and I really appreciate this list because you gave me something to talk about and something to think about and something to look at. And of course, some of them I was familiar with, obviously.
Yeah. Well, I think what the issue that we suffer with in Europe is that we don't have something like the EDGAR database with standards for data exchange. So the European Commission has a proposal in there, and I believe by 2027 they want to be at that stage that all companies report their numbers in the same format into the database as well. So which makes it hard sometimes. It means that we find lots of data mistakes in European companies, and we kind of end up usually double checking in 10Ks R&D quarterly. And many of the companies also on that list that you saw, they don't do quarterly earnings.
Yes, I did notice that, by the way. Yes,
because some do trading statements.
They didn't do quarterly dividends either. Sorry.
Yeah, exactly. Interim dividends, and then ASML as an example. There's 3 interim dividends and then a final dividend, which is higher, and it confuses the hell out of people what the real yield is and such. Yeah, we need to sweat harder here to get our stuff.
That was always, yeah, my original mentor. I mean, now that you bring that up, that's what he always said: stick to U.S. and companies, because we can trust the numbers better. But I think the kind of names you sent me there, those companies are probably, I'm going to say, honest with their reporting. They're not doing. I did have a client that was a forensic accountant, and he was, I won't mention the name of the company, but he was auditing a company in France, and he went to their headquarters and audited their numbers, and then they drove him in a private car to another location where he audited the real numbers, as he put it. but that was 50 years ago, 45 years ago. I think that's gotten a lot better. And, the markets have matured, and with social media, and not only social media, with the advent of the, everybody has all the, the Googles in the world, all the information in the world. The companies still can be crooked, but it's becoming more rare.
And how do you feel then about the company ADM that recently fired the CFO for an issue in the accounting issue in the nutrition business?
I'm actually working on that one. I don't have the answer. Now they're saying that there wasn't really as bad a issue as they possibly suspected at first, but he still needed to be fired. I think the stock is way overreacted. This is an A-rated company. It has very low debt, but it's one of those classic examples of a very cyclical stock that has a very long-term dividend record. So, my guess would be we're looking at a real great opportunity right now. And it's not so much a turnaround, because it is a cyclical company. So it's a matter of reverting to the mean, so to speak, going back to the norm. But, on the surface, it looks very excellent as far as the business goes. And if he was playing around, it was, they even pointed out, I think, in some of the stuff I read, that it wasn't severe, but there was some issues that they were questioning.
Cool. I think we might move on to some listeners' questions. We got quite a few that we have to get through. And look, the first one, we've got maybe 4 or 5, even 6 questions on this company, and it is your thoughts around Medical Properties Trust.
All right. Well, I knew it was going to come up. By the way, the thing about a stock like Medical Properties Trust, I look at that company like that as a specialty stock. Okay. Unfortunately, not everybody has enough money at retirement so that their portfolio can generate enough income for them to live off. And in those cases, sometimes you have to reach a little deeper for yield. And I'm not a yield chaser. I don't really believe in yield chasing. And that was a yield chase opportunity where I talked about turbocharging portfolios with its double-digit, dividend yield. Even after they've cut it, now you could still buy it with a double-digit yield. But the question is the dividend going to be intact or not? But here's the part that frustrates me about that. It's an inconsequential holding. It's not my ideal type of stock. My ideal type of stock is the ones that, like Elevance, I'm picking the U.S. companies, and, Ameriprise, and the old AmerisourceBergen, these companies that generate, year after year, they grow their earnings and grow their dividends. Those are the type of stocks that I love. So I did use Medical Properties Trust in select portfolios where, unfortunately, the people did not do what they needed to do to have enough income to live off. So they needed higher yield. And I had to get, I had to push for like a 5 or 6% yield on their portfolio, which then gave them enough money to live on. But to do that, you had to be willing to buy Philip Morris, Altria, or BTA, BAT, the British American Tobacco, and stocks, certain REITs, stocks like Medical Properties Trust. But here's the main point I want to say about that. I want to say that to all your listeners. And I said this actually earlier. You only get information 4 times a year. How do I feel? Nothing has changed since the last video I did or the last earnings report that have come out, except the fact that they're being more aggressive in going after Stewart. All right. This is a hospital company. The fundamentals, as they currently sit, dictate a significantly higher price. I think even Yahoo has their value at $23 a share. Their intrinsic value, fair value, they call it, I think. if the steward situation gets worked out, and I believe it will at some level, whether they either replace them or Stewart starts paying their bills. Stewart, I know, is fighting back. They've hired some advisors to try to see what they're going to do about catching up, pardon me, on their past rents. But here's my point. I don't have any difference in my opinion than the last time I talked about that stock until I see the next earnings report or next financial report, which I'm expecting to come out probably about maybe somewhere between the 20th and 25th of February. Now, once I see that, then I'll analyze, there could be some blockbuster news there. They could be announcing a dividend cut. They could be announcing a resolution of the Stewart deal. There's a million things that could happen. The problem is we don't know any of them until they actually do that report. Now, I bought this stock to own it for 5 years or more originally, and then got caught in the I didn't think the company's financials warranted them cutting their dividend. I understand why they did it, but I didn't think they had to. Whether they're going to cut again, like I say, let's see what the next financial report says, and then let's make a learned decision. Invest on the facts, not the. Again, what I talked about earlier. Just because the stock price is down, the stock price is a massive overreaction, and so is ADM, by the way, relative to what any analyst is forecasting might be happening to the company's fundamentals. So as long as those fundamentals stay where they are, then it is as you mentioned earlier, EGI, it's a turnaround situation at this point.
Yeah.
Risky, very risky.
Well, this personally, because I also look at those stocks, and then I'm wondering, and Derek and I are often preaching like the joy of missing out, and that is what I've been practicing there. Because honestly, for me as a European, I find it hard how there can be money made in hospitals, because I know the European system, which is mostly public, yeah. So for me, that's always been difficult, and that effectively that's why I didn't touch it. And I'm happy with it that I kind of stick to my rules. That if I like what Buffett says, circle of competence.
Amen.
So,
yeah. But again, like you talk about grocery store stocks, very low margin business, but what's the allure to them? They usually pay a nice dividend, and people go there every day.
Yeah.
Okay. Yeah. So they have they quote unquote make it up in volume. I hate that statement, but that's really what they're doing. But hospitals are essential, especially with my demographic. We're going to visit them, and they need to be there, and they need to exist. And whether they make a lot of money or not is not as important as whether they make any money and whether they stay in business.
True. Well, I hope that
it is real estate. And I will tell you this: I think maybe you would know, even give some color in this. It's very, very difficult to replace a hospital. To build, it's a very complex piece of real estate. It's not like building an apartment building or a home. It requires all types of, from an engineer standpoint, Derek, it requires all kinds of, special electronics and special wiring and special, to handle all the MRIs and all the stuff that goes along with it. So, the hospitals that are built, you're not going to see them just someone build one next to it, easily.
No, and what is interesting is, because you mentioned that Fresenius, the German company, was also popping up in your 5 European stocks. They actually decided to not pay a dividend over the current book year, 2023, because if I remember correctly, they borrowed 300 million from the government because of the spike in energy prices that we had due to the Russian and Ukraine war.
Okay.
So what you see here is also then, and they're not clear about that, but it sounds like that they are withdrawing this dividend for the cosmetics, because you don't want to go to the German authorities saying like, thank you for the money in the support of the energy prices, but we continue rewarding our shareholders. And Fresenius is owning and operating a lot of hospitals in Europe. Yeah. So.
Well, their earnings have been lousy for the last 4 or 5 years, but their valuation was also unbelievably high.
Yes,
and,
correct.
It looks to me like they're beginning to turn themselves around, according to what analysts are saying with FastGraphs.
Yeah.
But I don't know a lot about that business, so I'm just speaking to what I see on the graph.
Yeah. David has asked us actually about FastGraphs. He asked you, is there any upcoming updates or ideas that you have for FastGraphs?
I'm very, very excited about what's coming up on FastGraphs. I think we'll be launching in the next week a much better performance report. You know, one of my favorite mantras as Mr. Valuation is measuring performance without simultaneously measuring valuation is a job half done. People get caught up. The stock has not beat the S&P this year. It was way overvalued and it dropped at fair value now. It shouldn't have beat the S&P. So we've got a performance graph that's going to allow you to compare stocks. You compare it not just to the S&P this S&P 500 like right now. You can compare Home Depot to Lowe's. You know, you can compare Meta to Amazon. You can compare them to the market, you know, to the S&P. And it actually gives you a graphic, two different graphs associated with it that allow you to see how they performed in an absolute basis, but also why they performed the way they do. I think that's a real pet peeve of mine. People don't need to know just what the performance has been. They need to know why and how where the performance came from and how it was achieved. You know, was it because the stock was massively undervalued, didn't grow very fast, and, you know, they got PE ratio expansion, you know, or was it because their earnings grew 12 or 15% a year and the stock was reasonably valued at the time, or that underperformed because the stock was way overvalued? Like Walmart's a good example. Back in, say, 2000 to 2000 and say maybe 8, you know, the stock did crap. I mean, it was really a lousy stock, but the business grew 12 or 15%. But the problem was the stock was massively overvalued. So that's coming. So we stay on track. We also have a portfolio product that's coming where you'll be able to put your own portfolio in there and you'll be able to track your annualized rate of return, how much dividend income you've received. Tell you the asset allocation, what industries, how many, you know, what the actual weighting of the stock is in the portfolio. It's very, very exciting and powerful. And then we are in the process of negotiating with our data provider for a ETF package where we'll be able to, you know, put ETFs on FastGraphs as well as individual stocks. And of course, you know, the biggest one was we did do the international, where now we have like 80,000 stocks in almost every exchange on there. And by the way, you know, I've kind of enjoyed this because, you know, to be real candid, I'm pretty ignorant on the international stocks, but I'm learning and I'm finding it fascinating. It's one of those things that keep me going there.
Nice.
Something new to learn about. You know?
Exactly. Every day is a learning day.
Yep.
Hussein has asked us about valuation models. And in your opinion, should they be kept as simple as possible, or should it include lots of different metrics for accuracy?
You know, that's an excellent question, and I think it's something that, like, one of my pet peeves also, and it relates to your question, would be the effect of interest rates on valuation. All right, we actually had a graphic on FastGraphs years ago that compared price earnings ratios to changes in interest rates. So it had, one was PE ratios, and, you know, the theory, and I bought into the theories, the reason I developed the graphic was if interest rates, you know, increased, then PE ratios would shrink. And if, you know, interest rates shrunk, then PE ratios would increase. And that was great until it didn't work anymore. Okay, until it quit working. And see, the thing about it is, if you look at the source of return, okay, the source of all return are really, there's really only three things that make up what you're going to make on a stock. I'm talking about stocks now. And for that matter, most investments. Number one would be the capital appreciation or depreciation, the price moving from point A to point B, you know, and that is going to be a function of how fast the company grows. If it's a 5% grower, that's probably going to be a 5% number. If it's a 12% grower, if the measurement of valuation is done apples to apples. Then the second way, of course, is dividend income and the growth thereof. You know, people call it yield on cost. I hate that term because people misunderstand that. I call it growth yield, where every year the income, you know, dividends are based on the number of shares you own, not the volatility of the stock price. But then the third area is going to be what I call natural leverage. If you're buying with a margin of safety, especially, that's why value investing is so important. When you get leverage, you buy a stock at a 10 PE, its earnings grow X%, and then it sells at a 15 multiple. But my point is, regardless of all those things, valuation is always about discounting a future stream of income back to the present value. And there are thresholds. Any investment is worth a multiple of its cash flows, earnings. Okay, think about a bond. 5% bond sells at 20 times interest. People don't think of it that way, but it does. But it doesn't grow a bit.
Yeah,
it's always trading at 20 times interest. And an 8% bond trades at 12.5 times interest. And a 10% bond trades at 10 times interest. But that doesn't change the real value. The point is, as an investor, you always want to make as much money as you can, and so you want to focus on, one of my. I think I did coin this one, by the way. At least I never heard anyone else say it. My advice to investors is mind your owned, OWNED, mind your owned businesses. Okay, it's a play on mind your own business, obviously, but that you should pay attention to the companies you own, the ability for them to grow and how much they're going to grow and what value you're paying to buy them and how well their dividends going to do, because in an inflationary world, and I think that's a really realistic statement. Inflation is here to stay, and it's always going to be there. You want to make as much money as you can, and it doesn't matter what interest rates are doing. It doesn't matter what other bonds are doing or anything else. It's how much growth and value and income can you get from the individual stocks you own. So to me, valuations are barometers. They're references. Like in FastGraphs, we use a 15 PE. That's the normal valuation. That's the 6.5, 6 to 6.7, 6.67% earnings yield. That's the low side of the average return that the S&P 500 has generated for 200 years, 6 to 8%. So that becomes your barometer. It's a threshold of value. There is no such thing as a perfect valuation tool, including FastGraphs, but what we give you is the ability to look at valuation in a realistic way and analyze it and evaluate it and know whether you're overpaying, underpaying, or fairly paying for a stock. But a utility stock is going to, in America, in the US at least, is going to grow 2 or 3 or 4% a year. That's all the capital appreciation you should expect from that. And when you have a low growth stock, you got to be real careful with valuation. If you're buying a Home Depot or a Starbucks or a Lowe's or something that's maybe growing double digits, that 15 valuation still makes sense, because that's, you want to start out getting an earnings yield, but at least it's going to compensate you for the risk you're taking. But your future return is going to be a function of how much growth the business generates on your behalf, how much cash flow, earnings, dividends they're able to generate is all going to be functionally tied into how well the business performs as a business. And so to me, valuation is a timeless thing. It never really changes, and I'm not going to adjust my valuation ideas because interest rates have gone up or down. They're exogenous to the investment that I own. What's my business now? If I think rising interest rates are going to slow the growth of the business down, then I will factor that into my thinking. But a company that has no debt, what do they care what interest rates are?
Exactly.
If they're Amazon and they're growing like a weed, what do they care? They're not borrowing any money. What, I don't care. Right.
I have the same with Microsoft.
And Microsoft, yeah. Exactly. These guys. So it's what can they sell their product for, and how much elasticity they have in demand for that product, and and what is the size of the market they're playing in. Those are the kind of things we need to be thinking about. And there was a great quote that Warren Buffett did, and I can't recite it, but I can paraphrase it. It was something to the point where he said, 30 years ago, no one could have foreseen the huge expansion in the Vietnam War, wage and price controls, the interest rates going from 4% to 20% or whatever the number was. And he goes, all these other catastrophes, the oil crisis, he mentioned in it, and he says, but lo and behold, none of these things made even the slightest dent in Ben Graham's investment principles. And I think that's important. He doesn't focus on the macro. He never did. He minds his own businesses.
Yeah,
that's what he does.
I think I got to that learning when I really started to understand that it's a market of stocks and not a stock market.
Amen. But valuation is still going to be, in other words, you're going to have two companies, one growing at 10%, one growing at 2%, but their intrinsic value is still going to be around a 15-ish multiple, a 6 to 7% earnings yield. But the one's going to make you 2% a year, and the other one's going to make you 8% a year.
Exactly.
Because what value investing is really about is fully participating in what the business you're investing in is capable of generating on your behalf from a function of valuation, growth, and income, if any. At least in my world, that's how it works.
No, sounds reasonable. We've got two questions, one from Adam, one from Andrew, and around how you feel about real estate investment trusts and the hotel sector. And then to follow on with the real estate investment trusts, Andrew was asking what they might look like in a 2% interest world.
Well, see, there's a question where interest rates theoretically have an impact because interest rates are such a big part of buying real estate. And it's going to have a great deal to do with what your cap rates, you're going to be able to earn on that real estate and what cap rate you're going to pay for it. So, what the rise in interest rates have done is they've made REITs look very attractive. Now, hotel REITs, there are certain REITs I don't like today. I'm a little nervous on office REITs, for example, because obviously there's a new dynamic there. But by the way, that dynamic is starting to shift back where, everybody's saying you can work at home. So offices are, empty and corporations are abandoning their offices, but that may change. Hotel REITs, right now everything looks pretty good with those, but the valuation is what really matters. Like, one of my favorite REITs that I've never owned until just maybe a month ago is the big one. What is it, guys? What's the baddest REIT in the world?
Realty income.
Realty income. Okay, it's always been fully valued and overvalued because of the quality, A-rated, A-minus rated, whatever it is. But now finally, the fear of rising interest rates haven't really changed the prospects of that REIT very much going forward. The numbers, analysts are still expecting similar growth rates, et cetera. But what's changed is the prices now become reasonable. And I don't even know what it looks like today, what the exact numbers are. But, from a FFO, funds from operations, or adjusted funds from operations, all of a sudden you can buy this now with an AFFO yield of 7.29%. It usually trades at around 3 or 4%.
Yeah.
I mean, it's a great buy, and growth is expected to stay. By the way, no one's expecting high growth from this stock. This stock has only grown at 5%. The analysts are, with rising interest rates, saying 4% for the next 2 or 3 years. And, and 4% and 5% are the same number, as far as I'm concerned. But then what happens if, for example, the Fed does cut interest rates this year, as a lot of people are forecasting? And again,
Yeah, Brett Thomas was on the show not too long ago, and he was really, really making a strong case that, let's say, Q4 last year was the time to buy REITs. So far, from a price point of view, he kind of was right with picking the bottom, let's say. But
if you had FastGraphs and looked at all the REITs and looked at them, you'll see that now is a great. I did a video.
Yeah.
I did a YouTube video saying now's the best time, and I might have said decades. I don't remember what the title was, to buy REITs, because I think because the fear of rising interest rates killing them is more fear than fact, is what I'm saying. There is, keep in mind, one of the things that I was taught by my original mentor that really stuck with me was, he said, you really want to pay attention to management of the companies you invest in, because when things, hit the fan, so to speak, that's when you really need good managers. And that's what you're expecting them to do, is to make those adjustments and to be able to, run their businesses accordingly to whatever the scenario is surrounding them. And, and they do, the good ones do. The companies that have the great long-term track records, know how to run. They know their business.
Yeah. Kieran has asked us, is there any type of stocks that are not suitable for FastGraphs? No.
It's the fundamentals analyzer software tool. There's not a stock in the world that you shouldn't analyze based on their fundamentals. And by the way, this idea that FastGraphs is a magic, wand or a crystal ball. FastGraphs is a tool to think with. One of the things you've got to do with FastGraphs is make sure, because it's a dynamic tool, is if you're looking at a 20-year graph, you run it for 20 years, you run it for 15 years, you run it for 10 years, you run it for 5 years, because the growth rates are going to change, and the valuation parameters that are based on those growth rates are going to change as a result of doing that. But, there's not a stock in the world that I wouldn't want to know about the fundamentals of the business before I invested in any industry.
Makes sense.
And it also avoids getting trapped in adjusted earnings and adjusted EBITDA and everything here, because what I often see in some companies, they are really, you know how it goes, right? Management takes everything out of the earnings, that props up the earnings, but then anything that the way around inverted, usually it doesn't make its way, right? Currency. Let's say currency surprises that were favorable, they usually keep it in, but unfavorable currencies suddenly now that needs to be in the adjusted.
And what did Munger call EBITDA earnings before all the bad stuff?
Yeah, exactly.
You know, we show valuation in numerous ways. We show it in adjusted operating earnings. We show it in GAAP earnings. We show it in basic earnings. We show it in operating cash flow. We show it in free cash flow. We show it in EBITDA and EBIT. And then most importantly, I think, or I shouldn't say most importantly, but one that people always overlook, we show it in top line sales. Mm-hmm. And people ask me all the time, well, which is the best metric for me to use to value the business? And my answer is, if you're a FastGraphs subscriber, all of them, because why wouldn't you? It takes about 10
yeah, exactly.
You know, and investing in valuation is always a puzzle, and there are always numerous pieces to that puzzle.
Yeah. So
you want to look at a company, you know, in every way you can, but you still have to use judgment, and you still have to think. Yeah. You know, you still have to, you know, look at things like, for example, forecasting. You know, I often say the historical graphs tell us a lot about the company, the quality of the management. They give us insights into that, not comprehensive knowledge, but insights into those kind of things. But you're always only investing in the future. So the forecasting is what you really need to make your decisions on and pay the most attention to, because, you know, you can't buy what that stock did 10 years ago. You can only buy what it's going to do in the next 10 years. So, you know, but again, a tool to think with, you know, analyze the data and evaluate the data to the best of your ability and to the best of your knowledge, because sometimes you get surprises, ADM, you know, you mentioned earlier, you know, but then you gotta adapt to it. Wasn't it John Maynard Keynes that said, you know, someone criticized him for changing his mind or something. He said, when the facts change, I change my mind.
Exactly.
You know, I mean, that's the point. You always try to make the decisions on the best knowledge you can acquire at the time that's available. And that's why when you ask me about an MPW, I have no opinion until I see the next financial statement. And then my opinion is still going to be speculative to the extent that I still don't know everything that I need to know, but I'll know a hell of a lot more, excuse my language, than I do today once I see the next earnings report.
Yeah. MH79 has asked you, what was your first stock and which company has been in your portfolio the longest?
Oh, geez. I'd say my current portfolio, the one I still own, because I know most of the stocks I've lost have been taken over. You know, they've been bought out, you know, by another company. But Oracle might be one of the longest I've held currently. I've held that for maybe decades. The first stock I ever bought doesn't exist anymore, and probably one of the best stocks I ever owned is a company called Elsa. And you might be familiar. They were one of the original drug delivery companies, where they had several mechanisms where, you know, they delivered the drugs over a sustained period of time. I remember who bought them now. You asked me, you're going back 50 years, guys, plus. that was my first stock, and and that was the bad news. You know, I always tell people about going to Vegas or gambling. I said, you know, the worst thing that can happen to you is you win. Well, Elsa was a big boon for me. I made a lot of money in that stock, and I've been hooked ever since.
It's done you well, so it's done you well.
So, and I don't even remember the ones I lost money on, so don't ask.
Well, the loss is usually limited, right? And the wins are unlimited.
And diversification rules. You know, let's not have a, you know, podcast like this and not point out that I think I mentioned it earlier once. You know, that's why, you know, you don't put all your eggs in one basket. You diversify.
So I think we have a couple more questions. The cycling investor has asked for your opinion on AbbVie. AbbVie might technically be one of the other stocks I've owned the longest, because I got it through Abbott, which I've since gotten rid of. But you know, the Americ situation is obviously real, but you know, they've got a pipeline, and there are two new products
I haven't fully read the report yet today, but I mean, it looks like they're growing by 40 to 60% a year. So I think the Yamera is probably going to be replaced. I know that they were down.
They've upgraded their outlook with, I think, 27 billion in earnings in 2027. So it's like 6 billion more they're expecting. So this was like the outlook was really promising.
Now, I've owned that stock at a much, much lower valuation. Of course, I got it. If you followed it, I got it on the day that
spun off.
Abbott spun it off. So I guess my cost base will be something like 33. Yes, and I would have to go in and look. But it's been undervalued since probably 2018, and its valuation has been rising. It's now touching the orange line on the FastGraph, which is the valuation reference line, which says that it's now fairly valued. It no longer gives the margin of safety it did when I was originally keeping it. But I think people are realizing that Yamera is not the end of the world.
Yeah. Okay.
Although that is a good classic example, by the way, of good management. Having a good pipeline and being able to,
I found the Allergen acquisition brilliant.
Yes, it was.
They bought a really cash flowing business, and it paid a lot for it, so they increased debt, but it brought this diversity in the portfolio. It was really, really well done.
And they had their flagship product. The writing was on the wall. They knew what was going to happen.
Yeah.
Then the last question is from Kevin today, and he's asked about your views on private credit and BDCs. Do you think they are a good string to having your dividend portfolio board? He's asked.
I'm gonna take the fifth on that one because I don't really understand them. I think they're very, very difficult to analyze. They're very, very difficult to forecast. I don't understand the payouts of some of them, where it looks like they're paying out over 100% of their earnings, with cash flows. I just don't. I think there's a case of, to follow Warren Buffett's lead in my life anyway, and that's stay in your circle of competency. I don't like them, and don't. Was the second question, Derek, mortgage rates? Because I don't like them either. But that was
private credit, and then it's BDCs. So
because they have dropping earnings and massive cash flows, but they also have cutting dividends as a part of their legacies. I think they're just too difficult for me to deal with, so I've never even actually spent much time.
Yeah. I understand. Yeah, they are quite difficult. I suppose the allure to them is probably the high yields, which is what people are attracted to. But I would put them in a difficult pile as well. Stay away from them if you don't know them.
Yep.
Okay, that's the last question. Chuck, it's been an honor to have you on the show. It's been great chatting to you and getting to know some of your experiences and actually talking to you in person. I've been watching you on the screen for quite a long time as well. And I hope you've learned some things about European companies as well.
I did. And I'd actually like to keep this alive and learn a little more.
Definitely. Reach out whenever you have a question also about a European company or something like that, about the business or the products or something like that. Our community will definitely help you in clarifying that, Chuck. And for me as well, it was really, really nice for me because I've learned so much from you over the years. I learned first everything by textbooks, but then seeing a person putting the narration on top of it has really helped me, honestly, to become a better investor. So,
it's very nice to hear. Very nice to hear.
Okay. And to our listeners, we hope you enjoyed this, and we'll see you all next week.
I was going to say it's been my pleasure, guys. I've really had a lot of fun. So it was great talking to you, good questions, and quit asking me about MPW, guys. Wait till the next quarter.
Good. See you guys all next week again.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.